Welcome to this SMSF podcast episode where I'll be taking you through some types of investments that you can make in your SMSF. My name's Philip. I'm your host in this podcast series. Now, this is a very special episode where it's probably going to be divided into a few sections. I haven't decided how many sections there are yet because it's a fairly lengthy one. It basically deals with different types of investments that your SMSF can make and what are the taxation considerations that you need to look out for. Now, you've got an investment strategy already, hopefully, in your SMSF, and your investment strategy outlines what types of assets you'll be investing in your SMSF in order to make it grow. Hopefully, you will already have that. And you'll already be familiar with the different phases in your SMSF from the previous episodes. Now, you might be wondering as to why the cover page has football goals on there. Well, this is all about what are your goals in investing in certain types of assets in your SMSF. What do you seek to achieve? What's your end goal in making those types of investments? Yeah, you may be investing in shares or in bonds or in property, but what's your goal? What's your objective at the end of the day? That's what you need to consider in having your eyes set on a goal that you would like to achieve. Now, as for some of the different types of investments, well, we all know that shares are a very popular type of investment. A lot of entities have that in their investment portfolio. Now, shares can come in the form of Australian listed or global listed shares, or it can also be in the form of units in managed funds, whether it's Australian or international. Now, bear in mind, these shares investing in the stock market, it's a fairly highly risk investment because obviously the market is very volatile, especially in the international stock market. It's very highly volatile. And we've seen what happened in the global financial crisis of 2008. Australia has recovered quite fairly quicker than the other international share markets. But you can see the types of events that happen that cause a share market to tumble. Even nowadays with the COVID pandemic, you've seen that the global markets have taken a huge hit. Australian markets also have taken a big hit. They've started to recover, but they've gone down again. So, the markets go up and down in terms of shares and equity. Now, if you are investing in this type in the stock market, you need to do an extensive amount of research before choosing to invest in companies that seemingly provide you, let's say, with a high return, because chances are companies that provide you with a high return each month or each quarter or each year don't really provide you with a high capital growth in the long term, which is what a lot of investors are looking at. And especially in your SMSF, you will need to look at investing in the long term, not just going for 1 year or 2 years, because chances are a lot of these companies, they're not going to give you that long-term growth. So you need to do research on what are the well-established companies, ones that have really good reputations, ones that potentially won't let you down and won't let their investors down. That's a matter for you to decide and for you to have a look into. Now, managed funds, they're basically a type of investment where if you are struggling to diversify your assets, we spoke about that in the investment strategy segment, that you need to have a diversification of your portfolio allocation. What that does is it minimizes your risk, the risk in your portfolio, and it minimizes losses from other types of investments that can arise. Managed funds and particularly what we call ETFs. Please don't get confused with EFT because EFT is electronic funds transfer. ETF is exchange traded funds. These plus managed funds give you the opportunity to invest your money in that particular type, and then it diversifies your investment. So, for example, this managed fund or the ETF, it may invest in mining companies, banking sector, telecommunication sector, IT sector. So there's a number of areas already where it has a diversity of assets. So if you are struggling to diversify, maybe managed funds or ETFs are a good opportunity for you to take advantage of that. Now, managed funds come to you in the form of a distribution, whether it's quarterly or semi annually or annually. It depends on the fund's policies and a lot of other factors, and also where it invests as well. Likewise, ETFs they give you the distribution opportunity. Again, it depends on where it invests its assets. Now, these distributions are taxable, as you know. They can come in the form of interest or in the form of dividends. Now, shares that come to you in the form of dividends, it means that the company has already paid tax on its taxable profits and it's distributing dividends from its after tax amounts. Now, dividends can come in the form of a franked component and an unfranked component. Basically, a franked component is where the company has paid income tax and it has what we call a franking account balance. So, from that, again, depending on the policy of the company and on the amount or percentage of franked components, it will attach what we call a franking credit to its franked dividend. And that franking credit, where that the company attaches, is added to your SMSF as part of the taxable income. Now, that franking credit reduces your tax liability. So let's say, for example, if shares is your only asset in your SMSF, which is something that we don't really recommend, but let's say it is, you're taxed at 15% on the franked and the unfranked component plus the franking credits. But then the franking credits, if they exceed your tax liability, which they probably will, then your SMSF will be in a position where it will get a tax refund when it does its annual tax return. Now, your accountant and tax agent will be able to do all of these things for you and will advise you with more precise and more specific advice suited to your own circumstances. Now, if you are a little bit skeptical, but going back to shares and managed funds, when you invest in a managed fund, it will usually allocate your investment according to the strategy that you wish for it to allocate. So, for example, if you want to use an aggressive strategy, it will allocate your funds to companies or to different types of shares that will provide you with high returns every year but low capital growth. If you choose a more conservative approach, then it's likely that your fund will allocate your assets into a company where it will provide you with more capital growth. And then there's a balanced investment option where it will provide you with a mix of high income and long-term capital growth. So there are a few things that you can look out for and do your proper research on. The other type of investing is bonds. Now, bonds are also a type where you can invest in with a share trading account. Now, it's one of the interesting types of investment. It works similar to shares, and the good thing about a bond is it does not move as high and as much as shares move, but it still moves. Now, a bond can be a government bond or a corporate bond, and the different components of a bond, we have a face value. Usually the face value is $100. So if you purchase one bond, you will pay $100 on that. Generally speaking. Now, because a bond's been in existence in the market for quite some time, you'll usually find that it's worth either more than $100 or less than $100. Now, that happens because of changes in interest rates. So, as interest rates change, whether they go up or down, the bond value also changes, but not as much as the shares change. The other component of the bond is what we call a coupon rate. Now, that is a more competitive rate than an interest. It can be anywhere between 2 and 5%, or maybe 6%, depending on the bond's policies and nature of the bond and the maturity date as well. This coupon, the bond can pay you perhaps quarterly or perhaps every 6 months or every year, again, depending on its policy and how it pays its coupon rate. Now, the maturity date, that's also another component of the bond. It has to mature or expire. Now, a maturity time can be anywhere between 2 and something like 20 or 30 years. Again, it depends on the nature of the bond. Now, the longer you wait for the bond to mature, the more likely that it will either go up or down in value, taking into account the interest rates. So let's say you invest in a bond and you pay less than $100. You've got a good bargain. You get income from the bond into your SMSF, whether it's every 6 months or every year. And then after it matures, it will return its face value of $100. So you've made a small capital gain. In most cases, however, the bond's value is going to be greater than $100 because it's been on the market for quite some time and it's moved up for various reasons. So if you bought the bond at more than $100, then you will still receive the same face value of $100 when the bond matures at the end of its term, which means you have made a bit of a capital loss. However, the income that you receive from the bond, depending on how many years you've held the bond, it can cover that capital loss. However, a capital loss cannot reduce your assessable income. It can only be offset against a capital gain. So, investing in bonds, the taxation considerations is that it is subject to capital gains provisions, and the income that your SMSF receives from the bond is going to be in the form of interest income, which again, it's taxable in your SMSF at 15%. The other type of investment that has been fairly common in the past is fixed interest and cash. Now, once upon a time, we're talking way beyond the global financial crisis, term deposits rates were as high as around 10 to 12%, even a little bit more if you held the term deposit for more than 12 months. And that's made SMSFs grow up to that particular point. However, we do need to look at reality now, and in fact, the Reserve Bank has put its cash interest rate at 0.25%, which is the lowest it's been in Australia for a very, very long time, perhaps the lowest in the history of the country the interest rate has been. So, the more competitive term deposit rates, they'll probably provide you with 1%, and that's on the basis that you hold the term deposit for more than 12 months. So, in this day and age, interest and cash investments may not be a suitable investment. However, your SMSF does require to have suitable amount in its cash in order to pay for its short-term commitments. For example, if you're paying a member a pension, or if you're paying your tax liabilities, or if you're having to pay quarterly tax installments, you do need to have sufficient amounts in cash. Now, you don't really have to have $50,000 in cash or whatever, huge amounts in cash there, but sufficient to be able to cover any short-term obligations that you have. Now, there are a lot of other different types of investments that your SMSF can make, but due to the nature of this episode and this topic, it's going to be divided over a number of sections. So, in the next section, we'll discuss other investments like property, real property, and some of the other types of investments that have started to experience a growth in the past. So stay tuned for the next part of this segment.